we've got our Chief Economist here, David Bassanese, to walk us through, developments in global macro and also with the RBA as well. But before we move on, just a quick disclaimer that all information and content presented in this webinar should be considered general information only. If you did want to seek financial advice, you do need to seek your own financial advisor if you do wish to do so. For those who have tuned in, there will be a recording of this session that will be emailed to you at the end of the webinar. So don't feel like you won't have a copy, and feel free to ask a question. This is a live Q&A session. You can answer and pop in your question to the bottom right of your screen. Just type in whatever you want to ask. Just a bit about Betashares for those who may not be familiar with us. We're one of Australia's largest managers in ETFs. We've reached around the $40 billion in funds under management. But more importantly, we actually have over 1 million Australians who are invested in us, and it's a privilege for us to have this fiduciary duty to manage people's money. It's something that we take extremely seriously, and it's a proud achievement that we've had so far. And we have a wide range of funds. It's currently spanning around 90 plus funds across different asset classes, including equities, fixed income, etc. I mean, these charts here really just shows how much funds that we've taken in over the past financial year, even across both passive and active managers. You can see that Betashares has really taken in over $5 billion in funds over the financial year. So it's a feat again that we're extremely proud of. And within the passive space as well, you can see that as a percentage of the flows that have come in over the year, Betashares has ranked towards the top. We do also publish regular content as well on our website that you can visit at betashares.com.au, including information on our funds, blogs, research insights. We also have David Bassanese with his weekly Bass Bites on regular economic updates and markets as well. You can also follow us on our different social media channels as well. So without further ado, again, I'm really excited to delve into what's happening in markets, Dave. So I'll leave it on to you.
Thanks very much, Hugh. And Hugh will come back. He's going to give a quick update on some of the earnings results from the big tech companies later in this presentation. That's definitely his forte, looking at some of those industry level dynamics. So how I'm going to break up the presentation today, what's behind the recent share market volatility? What is part of which is this risk of a US recession that's sort of jumped up and is starting to affect investor thinking. Look at that. Look at the situation with regard to the US economy, and then just into the local situation, the local inflation, RBA policy outlook. A lot of new information that's come to hand in recent weeks, and just sort of give you an update on the state of play in that area. So firstly, the share market volatility. This is just a chart of the US S&P 500 index. It's a daily chart up until you can see the sell-off that we saw late last week. A couple of days there where the market was down actually 3% on the Monday, down around 2% or so on the Friday. But the point of this chart was to really make two observations. Firstly, the market actually peaked back in mid-July around here. In fact, I'll bring my cursor over here. A little bit weird the way these things work, but bear with us. So you can see here the market actually peaked in mid-July, and it peaked at, this is the RSI, it's sort of a measure of overbought, oversold levels from a technical point of view, and you can see it was at an overbought level. So the market, was probably overbought, looking for a reason for a pullback, and the developments of recent days have sort of contributed to that. But it was under pressure, even in late July, having a bit of a pullback, which for reasons I'll get into in a minute. Now, one of those reasons were, firstly, this is just a chart of the US fundamentals, the price index, forward earnings, PE valuations here, earnings expectations. So you can see here the market in the US is trading, has rebounded, it's trading at over 20 times earnings. If you take that forward earnings, or sorry, the price to earnings ratio, you turn it on its head, you get the earnings yield. And if you take you subtract the 10-year bond yield from that, you get this risk premium down here in red. And you can see this risk premium has shrunk to a relatively low level. It's sort of the lowest levels. You have to go back to the earlier last decade to get levels as low as we're at the moment. So from both an outright price to earnings basis and on an equity risk premium, the valuation of the market relative to bonds, the market was looking a little bit stretched. A lot of good news had been priced in. So, and I said, in a short run, at least, we're at overbought levels. So markets were looking for a reason for a bit of a pullback. Now, one of the catalysts for that have been some disappointments on the earnings front with regard to maybe an overreaction to some of those earnings numbers, but I'll let Hugh talk about that in a minute. Just in terms of the earnings, so obviously at the moment we've gone through the second quarter earnings reporting season in the US. Overall, it wasn't such a bad, it's still pretty good. Earnings are still growing. In fact, if I go back to this slide and I go over here, this is earnings expectations. So these are rolling monthly estimates of what analysts expect the level of earnings to be for companies in the S&P 500 index. And you can see the markets expect earnings in 25 to be well above levels of 24, and then in 26 above 25. So this forward earnings measure is a weighted average of these estimates. And the weight on next year's earnings increases as we get closer to that year. So you can see this positive earnings outlook has been dragging up this orange line, which is called forward earnings. And importantly, there's been no real reduction in the earnings expectations. They've been holding at these positive levels for a while. And so the earnings season hasn't really hurt that outlook. Just bring it, where's my over here? And if you actually look at the percent of beats, the earnings, so the long run average, and this is the percent of companies that have been in the June quarter that beat earnings estimates and beat revenue estimates. And you can see the 5-year average for earnings beats is something like 78%. So we're pretty close on that front. I mean, as at the last reporting there was 79%, so close to the long run average in terms of percent of companies beating estimates. And again, the old game in the US is that companies kind of lowball their estimates, and then most of them come out with earnings surprises, upside surprises. The market kind of factors that in to some degree. As you can see, on average, something like 8 out of 10 companies every earnings reporting season beat their estimates or beat the market estimates. Where there's been a little bit of disappointment is on the revenue front. And you can see something like 60% or 59.2% here beating revenue, which is a bit below the longer run average, which is consistent with the US economy slowing down, sales growth slowing down after that strong post-COVID rebound. But they've managed to hold up on the earnings front because of a tight rein on costs. But so if anything, it's really on the revenue front where there's been a bit of a disappointment. If you actually look at the tech companies, and I'll let Hugh talk about this a bit more or less, they kind of, most of them beat their earnings estimates as they usually do. If anything, maybe they didn't beat them by as much as they usually do. And there was some concern about investing in AI, but I'll hand over to Hugh if you want to give us a bit of color on about what's happening with Mag 7.
Yeah, sure. So, I mean, to your point, Dave, I mean, I think there's been so much scrutiny on these Mag 7 tech stocks. They make up such a majority of market indices, including the NASDAQ 100 and S&P 500. But, all in all, the earnings season for these companies weren't too bad. They did beat expectations in large, but not by a large amount. And so the market was generally worried about that beat. There were quite low beats, and there were a few misses as well. So overall the results were fairly mixed. The two main concerns really for these companies is two things. The first one is on the earnings sustainability, whether the companies that or the products that they're generating or they have, can they continue sustaining the growth rates they've had? They've been growing revenues 50%, 40%, etc., but that's slowly come down over time. And then the second thing is on the spending on AI, that is the capital expenditure. There is forecast to be a cumulative a $1 trillion spend across these 5 companies over the next 5 years. And the question on investors' minds are, will there be a return on these investments? But as you can see here, the net income growth rates have been, by and large, still quite fast. Alphabet 29%, Microsoft 10, etc. And it's really driven by new business segments that these companies have. That's predominantly in what we call cloud services. When you're looking to build a AI application, you need an infrastructure to be able to do that, and that comes with the cloud. You need to host your data, your web servers, all in within this ecosystem. So Amazon has Amazon Web Services, Microsoft has Azure, and Google has Google Cloud Platform. And what you see is a common theme across all of them. Yes, these stocks have sold off a bit, but the growth rates within the cloud businesses have actually accelerated because of the new generative AI opportunities that a lot of enterprises are looking to build out. So, all in all, the results were too bad. And, even when you account for their valuations on a forward PE estimate, which is essentially you taking into account what the earnings growth rate will be, for the rest of this year and into 2025. When you divide the price for that growth in earnings, they're actually not trading too far away. They're within the 19 to 30 times range, which isn't too bad. I think the market for the S&P 500 is around low 20s. With that pullback, it's around 20 times right now. So it's actually what we probably view as fairly priced. So yeah, that's an overview of
no worries.
the Mag 7 tech stocks.
Yeah, I mean, as you can see, the one kind of disappointment there, just in terms of results, is Amazon revenue being a little bit lower than expected. But otherwise, the surprises on the earnings front are all positive. The surprises on the revenue front there are all positive, bar Amazon. So there's a little bit of a market. Investors, I think, given they're trading at high valuations, investors are pretty demanding in terms of what they want to see. The results were still pretty good, but just not as good as some were hoping. And as Hugh mentioned, some concern about the massive spending going on in AI. Some of that AI is also defensive. I mean, all of these guys are competing against each other for AI dominance. So a lot of this investment is defensive investment. I mean, they've got to invest to stay in the game. And if they don't, and they can afford to invest because they've got quite strong revenue. So what's that expression you use? They can afford to invest. They can't afford not to invest.
That's right. There's a risk of not spending.
Yeah.
Essentially, yeah.
No worries. So look, just to summarise, why this pullback. Markets had got, had a strong run. They were sort of look at overbought levels, at least from a technical short run perspective. Valuations have been pretty stretched. The earnings numbers less than blowout. And so markets have actually been pulling back since around mid-July already. Now into that backdrop, we had the US payrolls report on Friday, which showed the US unemployment rate ticked up to 4.3%. Now, this has triggered something called the SARM rule, and I've got a chart of this here. And what on earth is the SARM rule? Regular listeners to these webinars may have heard me talk about this in the past. It's an observation that every time the 3-month moving average of the US unemployment rate, so you take that monthly number, you take the 3-month moving average of it, every time that number has increased by more than 0.5% from its rolling 12 monthly low, so whatever the lowest level of that 3-monthly moving average has been in the past 12 months, if the current number has increased by 0.5% from that, it's been close to the time in which the US has gone into recession. And you can see here the grey bars on this chart here, these are US recessions. There's a group in the US, the National Bureau of Economic Research, that sift through the data on a regular basis, and every now and again they think the data's weak enough to say the US has gone into recession. And if you look back in history at the times where they've said that that's begun, the unemployment rate on that measure has typically gone up by around about 0.5% by that stage. And that's the SARM rule. There's an economist, Claudia SARM, in the US, who actually made this observation that, you know, if you measure up when recessions kick in, the unemployment rate has typically gone up on that measure by about 0.5%. Now, why is that relevant? Because as of Friday, it has hit that 0.5%. So historically, you'd think, oh my goodness, that means we must be going into recession. Now, even the person who came up with this measure suggests this time could be different. I mean, famous words, every time we say that, it's not. But one of the differences is that usually when unemployment is rising, you know, the economy is already quite weak. Employment growth is contracting. And so the big driver of that increase in unemployment is weakness in labour demand. Now labour demand has softened, but it's still pretty firm. But one of the drivers is that labour supply has been rebounding. We've had a big rebound in immigration in the US, a big rebound in labour force participation post-COVID. So it's really a case of, yes, the economy is growing okay, but not growing strongly enough to absorb the influx of workers such that the unemployment rate has been drifting higher of late. And you know, I think to my mind, the fundamentals of the US economy are still pretty sound. I mean, corporate debt levels, household debt levels are pretty well contained. Both households and businesses, certainly mortgage holders, were able to lock in low financing during COVID. And a lot of you know, activity indicators, at least in the US, are looking quite good. So I don't see a reason for the US to need to tip into recession anytime soon. In fact, the ex-RBA governor, Ian Macfarlane, made an observation a few years ago, which I've always remembered and took to heart. He says recessions usually happen when there's a shock, you know, some big shock like a war or inflation or something like that, or some imbalance in the economy, be it a credit imbalance, you know, excess corporate lending, or you know, a failure of the, you know, take the US in the early 1980s, this implosion of the savings and loan a banking system, and most famously, you know, the global financial crisis of 2008, where we had a lot of subprime loans that were, you know, packaged up and then blew up. And so that was a credit bubble. But at the moment, no, there doesn't seem, yes, we had an inflation pickup in the US post-COVID, and we had it globally, but inflation, as I'll show you soon, has come back almost to the Fed target band. So inflation isn't the problem that it was, and it does mean that the Fed can actually support the economy if there is some weakness through lower interest rates. So at this stage, I don't see the case for the US tipping into recession, but the markets have obviously reacted to that number on Friday and had some concern. Now, I actually also think the payrolls number, there's been two things. It's actually like a 1-2 punch, if you like, for markets late last week. On Friday, we had that weak payrolls report in the US, or weaker than expected. But on Thursday, the day before, we had the Bank of Japan raise interest rates. Some expected them to do it, but I think the market consensus was that Japan wouldn't. Now, and just a quick story here, Japan has had, you know, zero negative interest rates for a long time. They've been battling deflation. They thought the way to tackle that was to keep interest rates at rock bottom levels. Inflation in Japan has rebounded. The economy is looking okay, and so the Bank of Japan has finally decided to start to lift interest rates from these zero levels. And last Thursday they raised rates 25 basis points. And as a result, what we've been seeing, and I'll just go to the next slide here. Is the yen. So this is the value of the yen versus the US dollar. So the yen has, you know, through the course, when the Fed was raising interest rates up until late last year, and the Bank of Japan wasn't, they were keeping rates at zero, the yen was weakening. You know, this is called the yen. What on earth is the yen carry trade? You may have heard, many of you may know what it is, but basically, if the interest rate on the yen is zero, or close to zero, and the yen is weakening, is under downward pressure, then it's a great thing to borrow. You can go and borrow yen, pay next to nothing on the interest rate, use that money, convert it into US dollars, and go and buy US tech companies, go and buy bonds, go and buy a whole bunch of stuff around the world with very cheap financing. And that is the yen carry trade, borrowing yen and buying other stuff. Now, when you do that, you take on foreign currency risk. You're hoping the yen stays weak and the value of those assets, go up. Now, what we've seen is that the yen has started to strengthen. In fact, it started to strengthen around about the time where markets peak. So this is the yen versus the US dollar. Also, it is the value of the Mag 7. So the Mag 7, the ratio of Mag 7 performance to the broader market. And you can see that they've started to underperform around the time that the yen started to strengthen. And so what's happened, all these fund managers around the world, hedge funds that have borrowed yen to buy, US tech companies, along with other things, once that yen starts to strengthen against the US dollar, all of a sudden, they're because they've used that money to buy US dollars, and now it's going to cost more US dollars to pay off their yen loans. They've got to unwind those trades, or they've got to say, oh my goodness, the yen's going up. This trade is looking a bit dodgy, so they've got to unwind. So what we found, again, so it's the strength of the yen has, and this is because the Fed, it's more and more likely the Fed is going to start to cut interest rates because inflation in the US is coming down, and it's more and more likely that the Bank of Japan is going to be raising interest rates, and as we saw last Thursday. So as interest rates, the US premium to the Japanese interest rates narrow, US rates coming down, Japanese rates going up, it's making the yen more attractive, and it's pushed up the yen, and you can see it's coincided with the unwinding of the relative performance of the Mag 7. So that's what we mean by the yen carry trade, and I think the abruptness of the sell-off that we saw certainly up until earlier this week, 3% down in the US market on the Friday and the Monday, it does smack of an unwinding of trades rather than a sudden concern about, if you're thinking there's a recession coming, that's usually a more gradual, you need a sort of gradual accumulation of evidence to sort of suggest that I wouldn't sell off, hugely just on one number. So just to summarize, it was really late last week, was like a 1-2 punch. We had the Bank of Japan raising rates on the Thursday, and then we had the weaker than expected employment report on the Friday, both of which basically meant that interest rates in the US more likely to come down, and interest rates in Japan are going up, contributing to the strength of the yen and the unwinding of these positions. So in summary, that's what's caused this volatility. It's some talk of US recession on the back of things like the Psalm rule, but I think at this stage you can maybe take that with a grain of salt. I don't think it's necessarily going to be as strong a signal as we've seen in the past, because the nature of the COVID cycle is different, as we've seen up until, since 2020, things have not played out the way economists generally expect, because the nature of the cycle with the shutdowns and the reopenings has been quite different. And then, coinciding with the unwinding of these big trades that have used yen borrowing to buy assets. What does this mean? Is the volatility over? Well, the yen carry trade may well unwind a bit more. I think, again, the Bank of Japan may look to raise rates more over the next 3 to 6 months, maybe not by a lot, and I think they'll be cautious because the Bank of Japan ultimately doesn't want the yen to strengthen too much, because it does then hurt the export competitiveness of their major exporters. So they'll be cautious in raising rates, but it is true that the US Federal Reserve will be cutting rates. I think they'll be less cautious in cutting rates with inflation coming down. So there is a bit more of that to go, but ultimately it's the fundamentals of the market that are going to drive things. So I think if the US does avoid recession, corporate earnings hold up, then this volatility should prove to be relatively short-term in nature. And just on that, what is the risk of a US recession? I've talked a little bit about this. This is the spread of the 10-year bond yield versus the 3-month short-term interest rate. And so when 10-year bond yields are well below the short-term interest rate, markets are basically pricing in aggressive interest rate cuts. And you can see every time they've tended to do that, it has coincided with recession. So this is yet another signal saying, maybe the US is heading for a recession because the markets are pricing in aggressive rate cuts, and the yield curve has gone negative. Now, but again, I go back to this point that COVID is a different type of situation. COVID, we had the lockdowns, we had a mini recession, we've had a strong rebound, we had a pickup in inflation due to supply-demand imbalances, but inflation has been coming down. So the Fed, I think, are going to be able to cut rates even without a recession, simply because they don't need to keep rates at restrictive levels if inflation is coming back of its own accord. So again, a bit like the SARM rule, it could well be that the yield curve, which ordinarily would be, flashing red here, or it is flashing red, could be a false signal. I'm always conscious of, anytime someone says this time is different, it's not different. But I think there's a good case to suggest that maybe COVID is different. So that's the situation at the moment. There's some traditional recession signals that are flashing red, but there's a lot of other signals that aren't flashing red. And my assessment of the fundamentals of the US economy suggests to me that these could well be false signals, at least for the foreseeable future. Another, I guess, factor there, this is interest payments. So the net interest payments by US corporations in billions of US dollars. And every time the Fed historically has raised rates, you can see their net payments have gone up. They're having to pay more. But look what happened over the last few years. It's plummeted next to nothing. That's because they basically locked in low financing when the Fed had interest rates at zero, and the Fed, at one point was promising not to raise rates for several years. So longer term bond yields got to very low levels. I mean, 10-year bond yields at one point in the US were under 1%. So they were able to borrow money. Not only could they borrow money at cheap rates, they could reinvest that money into higher yielding assets and actually earn a positive income on those assets, at least for a time. And you can see the net interest payments fell away. So just to underline the point that corporate balance sheets are in pretty good shape, unlike we've seen in past cycles. So again, contributing to this argument that maybe this time is different in terms of recession risks. Now, the other point to note, again, this is a chart that I usually present. Now, this is a little bit updated. On Friday, this number went to 4.3 from 4.1. But inflation, the core inflation rate, has dropped down to 2.6. And you can see that's been a very nice decline. Now, if you squint your eyes and look carefully, earlier this year, this annual rate of inflation did go sideways for a little bit. So there was a brief inflation scare in the US where inflation was proving to be a bit higher than expected. And the markets, which had aggressively priced in rate cuts this year, priced them out. Bond yields went higher. But now that decline in inflation in the last 2 to 3 months has resumed, and the markets are starting to price back those rate cuts. Happy days. So things are looking good, I would argue, in terms of the US economy at the moment. Now, supporting the decline in inflation at the same time as the economy's been holding up has been this solid rebound in immigration. So this is a chart from the US Congressional Budget Office. It's their estimates of what's going on with US immigration. And you can see here, annual growth dropped away next to nothing during COVID, during the lockdowns, and it's bounced back quite strongly since. So again, it's this positive labour supply that has meant that the excess demand for labour has eased, but it's eased because of a positive supply response more so than a negative demand response, which again is why the increase in the unemployment rate it's not being driven by the same factors that we've seen in past cycles. So that's really all I want to say about the recession and what's behind the market volatility. So it's just to summarize, markets were vulnerable to a pullback. They've been oversold levels. Valuations were getting rich. The tech companies reported they're okay, not as blowout as they have been traditionally. Plus, we've had a few, the 1-2 punch from the Bank of Japan interest rate increase and the weaker than expected US payrolls number. into the mix, added to the volatility and the sell-off that we've seen in recent days. But the fundamentals, I still think, are pretty good for the US economy. I think the Fed is going to come to the rescue and start to cut interest rates at the start of starting next month. So I think this is just going to be a correction in the market rather than the start of a recessionary bear market. Now, what about in Australia? Local inflation, the RBA. So this is a snapshot of the situation here. Unemployment around about 4.1%. So a bit like in the US, it's been gradually moving higher, but it's still very low by long run standards. And part of the reason for this is, yes, demand has softened, but it's also been a strong rebound in immigration and labour supply. But this is not too bad. The RBA actually want the unemployment rate to drift up a little bit to help bring down wage pressures and service sector inflation pressures. They argued back in 23, unemployment at 3.5%, the labour market was too tight, but and they would like it to actually be around about 4.2, 4.4%, even 4.5% would be, the RBA's assessment of what would be a balanced labour market. But the other thing that's happened lately, so this is the monthly trim mean. So trim mean inflation is the underlying measure of inflation in Australia. We get two measures of this. We've got the monthly measure. You can see it in grey here. I'll go over here. So this is the monthly measure, and this is the quarterly measure in orange. And so the monthly measure tends to be a bit more volatile. And in fact, so far this year, up until the latest reading for June, it was moving higher. Hence, the markets were fearing that the RBA may need to raise rates because the decline in inflation that we've been getting appeared to be reversing. Then come the June number, which we got a couple of weeks ago, actually last week, it dropped from 4.4 to 4.1. Still, higher than we would like, but certainly better than the 4.4. And then we got the quarterly CPI, which is a broader, it's the best measure of inflation, but it comes out only every 3 months rather than every month. And that ticked down to 3.9 from 4. So it was a bit of a decline. And so bottom line here is inflation last week was better than feared, but it's still not, great in the sense that inflation is still higher than we would like. And at this stage, as you can see, the rate of decline in inflation has slowed from what we were experiencing in 23. So we've had a bit of a hiccup in the decline in inflation, a bit like what the US had also. I mean, the US, as I said earlier, there was a few months earlier this year where the US numbers were a bit higher than expected, but then that decline resumed. And I do anticipate that this decline will resume, but it's going to be gradual. And the RBA have patience. Provided this number continues to decline, then the RBA can stay on hold and eventually deliver interest rate cuts. My base case is the RBA will cut rates now, not this year, but in February. Now, why February? Because we'll need at least 2 quarterly CPIs to confirm further declines in inflation before I think they would be confident enough to cut rates. And that second quarterly number doesn't arrive until January next year. That'll be the December quarter CPI. So if the September quarter one shows a further decline in inflation below 3.9, and then the December quarter one shows it around about 3.5 or maybe a bit less, then that'll be enough ammunition, I think, for the RBA to at least start to take the foot off the brake. Remember, it's on the brakes at the moment. Interest rates are above average levels. So we don't need to get back to the target completely before they start cutting rates, but we just need confirmation that it is on the way back to target. But so that's the state of play with regard to inflation. And if you just drill into it a bit more, thing about inflation in Australia, there's over 120 different items, and you can cut and dice these things any number of ways. I don't really like the way the the ABS cut them because it's quite messy. I think the clearest thing is to strip out core versus non-core. Non-core are things that aren't driven by the market, so they're like things that are largely driven by government policy, things like school fees, sort of childcare fees, electricity, these sort of non-market driven prices, and that's in core. And you can see here the annual rate of inflation for core, I'll come over here, is it's running at 4%, which is actually, it's always risen at a relatively high level. So it's actually back in line with where we were prior to the pandemic. So core inflation, yes, it's high, but it's more or less back to where it was prior to the pandemic. What is higher than the pandemic is core CPI. So these are market goods and services. And you can see that's also at 4%. But prior to the pandemic, it was running at around about 2%. So we're twice where we were. So now you can take that core CPI and break it up into goods versus, well, break it up into three components. Housing, things like housing, construction costs and rents. Goods, other goods like clothing, furniture, cars, these sort of things. And then services, financial services, which includes insurance, hairdressing, hospitality, takeaway, all this sort of stuff. And if you compare where we are today versus pre-pandemic levels, the sticking goods are fine. So the grey line here, you can see goods inflation is back to where we were prior to the pandemic. But the sticking points are housing. So this is rents and housing construction costs and services. And these are things like, if you can drill down further, in fact, I've got it here. This is core services. It is things like restaurants and takeaway. The price of restaurant meals and takeaway because of the increase in minimum wages, the increase in rents and electricity, a lot of costs that these cafes and restaurants have had to bear, and they've been passing that on, is still higher than where we were pre the pandemic. And the other one there is financial services, and in financial services is insurance. And I'm sure as many of you are aware, car insurance, household insurance has gone up, partly because, well, in large part, because of the increase in damages bills that they have to pay due to the increase in natural disasters that are happening, which many argue, and I think correctly, due to changing climatic conditions as a result of climate change. You may not believe in all of that, but the reality is that bad weather events have increased, and that's been reflected in the damages bill and the insurers needing to increase their insurance premiums. So that's really drilling into services, some of the sticky things relative to where we were prior to the pandemic. Just out of interest, the other interesting thing to my mind, if you break it up further, this orange line on the second chart is telecommunications. So these are things like the internet, mobile phones. Now, prior to the pandemic, that was running at a negative rate of inflation. Today, it's running at close to flat. So flat is good. It's still, not big increases in prices, but it's still higher than the rates of deflation that we had in this area prior to the pandemic. And the other one is just a whole bunch of other things like core services, which, prior to the pandemic were running close to zero, whereas now they're running still a bit higher. So there's been some structural issues potentially. So the rate of deflation in telecommunications has eased, which is adding to some of the inflationary pressure as well. But the sticking points at the moment are insurance costs, housing costs, hospitality, and restaurant costs. Now, I'm hopeful that insurance costs, the rate of increase will slow. And also, once the increased costs that restaurants and takeaways have had to deal with are passed through, we're all now paying, I don't know, $35, $40 for a plate of food at a restaurant. I don't know what you can afford at a restaurant, but it's certainly testing me. Once that's passed through, then hopefully the rate of decline, we can go back to a slower pace of inflation there. So I just thought I'd share with you, drilling down into some of the inflation numbers in Australia, what's been driving it. So again, just to summarize, it's housing, it's rents due to housing shortages in Australia, the big rebound in immigration, at the same time as we've had a reduction in housing construction, partly because a lot of resources, labour and materials are being dragged into the infrastructure boom that we're having in terms of, toll roads and metros and all and the like, and clean energy, new clean energy projects, solar and wind. So that's sucking a lot of resources out of the housing sector. So that's put pressure on rents, put pressure on housing costs. But there's a whole bunch, hospitality costs, insurance costs. These things also are adding to the inflation challenge in Australia at the moment. Another challenge for us, and I've just got a few final slides here. I want to leave some time for questions. So this is and again, one of the frustrating aspects of the economy at the moment is, yes, growth is soft. The rate of growth of GDP is only like something like 2% or a little bit less. The rate of growth of consumer spending is pretty soft. So that's the rate of growth. But the other thing to think about is the level of demand relative to supply. And the RBA argues that the overall level of demand is still relatively high compared to the available supply. And they get that from a bunch of things, but two key ones are A, the unemployment rate is still pretty low, 4%, near their 50-year lows, and measures of capacity utilization, if you look at business surveys, are relatively high. So businesses are saying they're operating at a high level of capacity. So that leads the RBA to say, well, we are, part of the inflation story from a broad macro perspective is just the level of demand compared to supply is still a little bit too high. Now that's going to frustrate many because it means the RBA does want growth to remain soft. It wants demand to come back to that supply level. So it's looking at the weakness of retail spending and not sort of getting too upset about it, because the harsh reality is that's exactly what the RBA wants to see at the moment, and it's not going to give us any leeway on that front anytime soon, given the inflation backdrop. So what I've got here, this is a slide from the RBA, and it's their estimate of the unemployment, a level of unemployment relative to equilibrium, or what they think is a normal level. And their broad range of estimates suggests we're still operating at an unemployment rate below the balanced level. You can see there on the top slide. And underutilization, if anything, I mean, it's a kind of weird concept, underutilization gap. You could invert that and call it the utilization gap, but I think the underutilization gap is negative. It basically means we're still operating at an above average level of capacity. Trust economists to come up with this underutilization gap and have it negative, but that's essentially what it means. So again, the bottom line here is the RBA's range of estimates suggest demand is still running high relative to supply, and why they're not going to come to the party with a rate cut anytime soon, unlike the US Federal Reserve, which they've had better progress on inflation, so they can afford to do that. But the other but the RBA is prepared to be patient also. They're not of a mind. If inflation goes sideways from here at 4%, they will have to raise rates. So it is important that those quarterly CPI numbers that we get over the next 6 months do show further declines, because if in 6 months' time, underlying inflation, annual underlying inflation is still 4%, RBA is not going to be happy about that. They're going to have to raise rates. But at the moment, they're prepared to wait. And one of the reasons they're prepared to wait is, I'll go back over here. If you look at inflation expectations, they're still relatively contained. So there's a whole bunch of survey measures of what businesses, consumers think inflation will be over the next few years. And at the moment, most of those indicators suggesting they still see it coming back to the target band. If the RBA saw evidence that inflation expectations were being ratcheted up, that would make them less willing to wait. So it's that balancing act. Provided inflation expectations are contained, they can be patient and wait for inflation to come down. If we see evidence of that changing, then they can be less patient. But at the moment, they can be patient, and we'll play the waiting game. So just last but not least, what does all this mean for interest rates? You can see that at the moment, the markets, this is what they're expecting. There's been these things chop and change, but at the moment, the markets are expecting, the markets at the moment are still expecting a rate cut from the RBA this year. I think it's a reaction to the volatility on the share market in recent days. I think that's probably still overly optimistic now. The RBA governor herself has sort of downplayed that, but they've got rate cuts being priced in through 25. In the US, they've now got rates being cut by year end. At the moment, the US Fed funds rate is about 5.25, so they see it coming down about 2 to 3 rate cuts by year end. The rate going down to about 4.25, and then more rate cuts through next year. So the markets are now, pricing in back to pricing in relatively aggressive rate cuts in the US, which I think is warranted. I think we will get rate cuts in Australia also next year, but maybe a little bit overly optimistic to think we can get them as early as this year. I'll leave it there and open it up for questions.
Great, thanks so much, Dave. I hope everyone found that session extremely insightful. We've got a few questions that have come through live. The first one, David, do you expect volatility to increase in the second half of the year? We've obviously seen this 1-2 punch from the yen carry trade unwinding, the softer payrolls data, but you've got a US election coming up in November. You've got some geopolitical risk between, in the Middle East. So just what's your thoughts on volatility going forward?
Look, to be honest, I don't think geopolitical risk, any things can blow out. It's hard to predict, how that will play out. I mean, my core thing on geopolitical risk, if you look at, Russia, Ukraine situation, you look at the Middle East situation, this could be naive or overly optimistic, but so far at least the events in the Middle East, the events in Europe, as terrible and as tragic as they are for Gaza and for Ukraine, have remained relatively contained to within Gaza and within Ukraine. They've not spilt out. Russia's not gone to war with Poland. Germany's not invaded Russia. We've had none of this. And this stage, Israel and Iran and even Lebanon, they've had some skirmishes, but there's been no full outbreak of war there. And I think, go back to the Cold War, and again, the Cold War, we had this thing called mutually assured destruction. Russia and the US, there was tensions between them for decades, but they never fired nuclear weapons at each other because they just realized the consequences of that would be so terrible. And I think Russia, even like Israel and Iran, yes, they've traded some rockets here and there, but they both acknowledge that escalation, like to a full-blown war, would be pretty catastrophic for both parties. And so I don't see that happening. Well, as terrible as it is, I think they still, would try to avoid that escalation. And similarly in Europe, I don't think Putin would be crazy enough to, escalate the war beyond Ukraine because, everyone else is in NATO. And as part of the NATO treaty, if he did do anything in some of those other countries, it's going to drag everyone into a massive war. So, they rattle the sabers, but they do not escalate. So that's my assessment. It's going to be simmering, but I do not anticipate escalation. But, that's obviously something we've got to keep watching. In terms of the US election, look, the markets, I think, the big issue in the US is the budget deficit. The markets are still relaxed about that budget deficit. I mean, bond yields are still coming down. It's still being driven by Fed policy, not concerned by the budget deficit. And both sides of politics in the US basically don't care about the deficit. Trump probably cares a little bit less about it than Harris. He's more willing to cut taxes, even if it means a bigger deficit. But until the markets care about it, we're never quite sure when they will care about it, then it's just going to be this sleeper issue. The big difference between the two parties is, I boil it down to old energy versus new energy. They're big, policy differences from an economic point of view that, under Harris, you would get more, as we've seen under Biden, more investment, encouragement of the clean energy transition, whereas under Trump, there'd be more, drill, baby, drill, as he says, and he favours oil and old energy. Though he does now favour electric cars, apparently, because Elon Musk is supporting him. So that's a bit of new information. Bottom line here, I mean, I'll go out on a limb here. I reckon Harris is going to win the election. You've heard it here. I think the polls are shifting. I think there's a lot of excitement behind her, and I think the VP choice that she's done has been quite astute. And I think, maybe I'm an economist. What do I know? But my sense is there seems to be building excitement around her, and I think as she's come out of the shadows from Joe Biden. I mean, Joe Biden probably kept her in the shadows, you know, because he wanted to run for election up until recently, and even through his first term, she never really had much of the limelight. But as she's come out and, you know, she's presented herself, I think she's being seen as quite a warm, attractive candidate. You know, attractive in the sense of, you know, appealing on a policy front. I don't mean to get, you know, talk about looks or anything like that, but I mean, attractive candidate, you know, from a Democrat point of view, surprisingly good, you know, because no one knew much about her beforehand. So that's just my sense. I think as we get there, you know, I think there's a very good chance that the polls are shifting, and Trump, you know, a couple of weeks ago was odds-on certainty to win versus Biden, whereas now it's a very much more contested situation.
Right. And there's been a few follow-up questions on, you know, the impact on markets. You know, it seems like you've got a pick on Harris. You touched on some differences in performance between old and new energy. Can you touch on, you know, whether, you know, markets, you know, will remain buoyant, you know, whether that's in the US or in Australia? I mean, I'm sure many of our listeners appreciate the impact on markets as well.
Look, bottom line is, you know, we're still going through this soft landing scenario. I mean, that is the key. You know, there's a lot of noise out there in markets, but the ultimate key driver of markets is, can the US avoid a recession? Can inflation come back down to the target zone of the Federal Reserve of 2% without the economy needing to go into recession? And that is still the base case scenario here. Inflation, you know, is now 2.6%. Yes, growth has softened, but I don't think it's going to fall in a hole. And the Fed are coming to the rescue by cutting rates in September and maybe a couple of times thereafter. So there's every reason to think equity markets can hold up and grind higher from here. And if you think about it on a 12-month view, I think broadly valuations, certainly from a global perspective, aren't too bad. I mean, they're trading at 17.5 times earnings. The US market is trading at over 20, but a big part of that is the large cap tech companies and their very rich valuations, which some would argue, I think Hugh would argue, that not too, you know, given the earnings they're generating, maybe that's justified. But the earnings story globally is still quite positive. And so even if PE valuations stay where they are, equity markets can grind up on the back of the earnings growth that's likely. Up until recently, it's been both earnings and PE valuations, but maybe PE valuations are now topping out, but the market could still go up on the basis of the earnings numbers. And one of the questions globally is going to be, even if we stay in the soft landing scenario and equity markets grind higher, albeit with volatility here and there, you know, never rule that out. But I think in a trend sense, we're still in a bull market here. Is, can the cheaper non-US large cap areas, so Europe, Japan, emerging markets, Australia, small caps, can they rally broaden to some of these areas? And my base case is that it will, even in the face of lower bond yields. I think we'll start to see a rotation. Doesn't mean the tech companies will slump. It's just maybe they won't go up as much as some of these other areas that look relatively cheap at the moment.
Great, thanks, David. Just following up on a different tact, I guess this plays into volatility as well, but your outlook for the Aussie dollar, you know, I think you had a call for a range within the 70s. The Aussie against the yen has fallen off sharply. So yeah, just what your thoughts are on the Australian dollar.
I'm positive on the Australian dollar. I mean, I've been calling it to go to 68 cents by year end. That's on the view that the Fed would be cutting rates more aggressively than us. Obviously, with the volatility in recent days, anytime you get this sort of volatility and fear of a US recession, the Aussie dollar gets smashed, and so it's gone back down to 65 or 64 at one point. It's now, I think, drawing, you know, it's trying to drag itself up off the carpet again. But the bigger picture here is that the Fed has got more room to cut rates over the next year than the Fed, RBA, and in a soft landing, you know, positive global growth environment, that should be positive for the Australian dollar, as interest rates in the US come back down relative to us. So the interest premium on US investing in the US dollar drops. It'll make it relatively more attractive to invest in the Aussie. So Yeah, so I think it can hit 68 cents by year end and maybe 72 cents first part of next year.
Great. On inflation, Australian inflation has come back a bit, although it is, undoubtedly, I guess, slightly more stubborn than some other developed economies like the US. Why is that so? You've touched on some reasons, insurance, services, rent, etc. But why doesn't the US economy face the same effects? That would otherwise raise their inflation numbers up. Why is there that disparity?
Look, one difference, and I think Governor Bullock, RBA Governor Bullock pointed this out earlier this week. I mean, service inflation in the US is also, relatively high. So goods inflation, but the difference between the US and Australia is goods inflation is lower in the US than it is here. So service inflation, broadly speaking, is still firm in the US. As it is in Australia, as it is around the world. But the difference between Australia and other countries at the moment is that we have less, we still have higher goods inflation. And one of the reasons for that is that we have higher rental and housing costs, which are part of the goods inflation, particularly rents. So rents are still quite firm in Australia. Now, the other one is housing construction costs, and RBA Governor Bullock pointed this out, that in some countries, in the US, for example, housing construction costs, now we include in the CPI because it's seen as the price of new housing. I mean, they weight it, it's got a lowish weight, but it's not included in the same way in the US. So that's one of the differences as well between the two.
Right. Donald Trump and his tariff policies. If Trump wins,
sure.
There's been talks on a global tariff charge of around 10%. Some countries being a bit more.
Yeah.
How is that likely to affect on global trade? Particularly in countries like Europe that relies on trade to and from the US. What does that look like, I guess, across different countries?
Yeah, I mean, this will be a new source of volatility if Donald Trump gets back into power. I mean, he did this last time. I mean, we've been there before. I mean, he had trade, if you recall, he put trade sanctions on Europe. He put trade tariffs, on Europe. He put tariffs on China. Both China and Europe retaliated. I mean, there was a tariff on, Tennessee whiskey at one point and Levi jeans and these sort of things, and China retaliated. Now that added to some short-run volatility in markets, but equity markets broadly held up. So I don't think the tariffs that he would impose, would it cause bottom line is, will it be bad enough to cause a global recession? No, it won't. It'll cause some volatility, some angst, and a lot of what he does is really for show, to appeal to his base. But he would be smart. Well, is he smart? I mean, he's a business person. He's got a lot of business people that he talks to. I think he would know not to be too crazy to do anything that would disrupt the global economy and certainly the US economy, because he'd be blamed for it essentially.
Exactly right. We'll probably have that's it. Thanks so much for tuning in, everyone. I hope you enjoyed the session today. With Dave. On the global macro and economic update. And if you had any follow-up questions, feel free to reach us on our website or email.
And we'll try to reply.
Yeah, definitely. So thank you so much, everyone.
Cheers. See you next time.
This should be a stop button. Stop sharing screen. Stop recording. Okay. I think that's it.